Yes, we are going to start chapter number 3, valuation of goodwill. What is valuation of goodwill, What is goodwill, first of all? It is an intangible asset, right? Intangible assets means what? Which you cannot see. Which you cannot see and feel, right? That is invaluable assets. That is intangible assets. Now, we will see how to value the goodwill. Valuation. There are different methods of valuation of goodwill. We will see step by step. First method we will see that first is average profit method. What is average profit? Means total number of years, total profits, all the years profit we add, total profit, divide by number of years. That is average profit. Okay, so average profit into number of years purchase. That is called valuation goodwill. The value of goodwill we will get after multiplying the number of years purchase. So we will see by illustration. That is, first illustration is determine the value of goodwill based on 3 years purchase of last 5 years average profit. So that means we want average profit first. So average profit means profit is given, year wise it is given 12, 13, 14, 15, 16. Then the profits are given 2 lakh, 2 lakh 10,000, 190, 2 lakh 15, 220. So what we will do? We have to add all the years profit, total profit. So what is the total profit? If we add this, it is 10 lakh 35,000. So what is the formula now? Average profit. So that is total profit. This is total profit divided by number of years. Number of years means 1, 2, 3, 4, 5. So you have to divide by 5. So what do you get average profit? 2,07,000. Now in the question we will see what is given. That is last 5 years profit is given. Determine the value of goodwill. That is goodwill we will calculate. Goodwill is based on 3 years purchase. This is 3 years purchase. So you have to multiply by 3. So we will take here the profit. We will take the profit here. So we can see, so how the goodwill is calculated now, you can see the goodwill. What is the goodwill calculation method? Yes, so average goodwill means you have to take the average profit into number of years purchased. So average profit we have taken as 2,07,000. So we will 2,07,000 into 3 if you multiply, because it is 3 years purchase. So what you will get the answer? Final answer is 6,20,000. So the goodwill valued is 6,21,000. The value of goodwill of any firm is calculated this way, right? So this is 6,21,000. Okay, fine. It is clear. So we will see another example. So this is weighted average profit method. What do you mean by weighted average profit method? Weighted average profit method means what? Weighted average profit means what? When the profit is continuously increasing. When the profit is continuously increasing, that is 80,000, now it is 120. It is increasing. Every year you can see it is continuously increasing. When there is an increasing trend. So what you have to say? When there is an increasing, you have to see whether the profit are continuously increasing. That doesn't mean that 1 year increase, second year decrease, then increase, then decrease. It should increase continuously. It is a continuous trend. That means 80, 120, 141. So in this thing, you have to use this weighted average profit. So weighted average profit is slightly different from the previous method. Now we will see that this method, there is an example given. See, these are the profits given. You can see these are the profit given, and it is written here also that you have to use weighted average profit method, right? So weighted average profit method is calculated this way. You can see that weighted average profit means, see, this is the table. You can see the table. You can see the tables given. So see, this year first you have to write, then the profits Then you have to take the weights. Weights means first year, the base year you have to take 1, then go on increasing. If it is given in the question, use according the weights. Otherwise, you have to use these weights only, starting from 1. Then go on increasing 1, 2, 3, 4 and 5. And then you have to multiply this 80,000 and weight, profit into weight. So you will get the product over here. So this product you got it. So you will get the product over here. So that I can show you here the product method. The product is, product you can see 80,000 into 1 is 80,000, right? Then second 1,20,000 into 2, that is 2,40,000 and so on. 140 into 3, that is 420. 1,60,000 into 4, that is 6,40,000 and 1,70,000 into 5, that is 8,50,000. Is it clear? So this way, then you have to take the total. That means you have to take the total. How you take the total then? See, this total you have to take this column total and the weight column total. Only 2 columns total is required. So you don't take any other column. This total is not required. Only this 2 column total is required. So this product is 22,30,000. So that now what is the formula for that? Weighted average profit is total weighted profit. That means this total upon total weight is this 15. So you have to take this total divided by total weight, that is 15. So you will get the weighted average profit. This is called weighted average profit, right? When you see the weighted average profit, it is coming in point. So what we will do? In accounts, we don't take in points. We round it off to nearest rupee. So what will be the nearest rupee? It is after point. It is if it is 5 and above. If after the point, the first digit is 5 or above. So that means you have to increase the previous before the point. This is 6. What is before the point? It is 6. So what you have to do? So you have to increase it to, yeah. So this 6 we will increase and we will not take the point. So 148,667, round it out to 7. Okay. Then after that, what do you have to do after that? Now the goodwill valuation. Step number 3, goodwill is equal to weighted average profit into number of years purchase. So number of years purchase, you have seen in the question what it was given. Number of purchase, you can see in the valuation. So goodwill is valued at 3 years purchase. You can see your 3 years purchase. So you have to multiply by 3, right? So it's multiplied by 3 years purchase. So you get the value 4,46,001. Okay, is it clear? So we will move ahead. Next question we will see that it is a different method, valuation of goodwill and the basis of super profit. Now what is super profit? Super profit means, the formula for super profit is average profit minus normal profit. What is average profit? We have seen average profit first in the first illustration only, average profit. Then what is normal profit now? Normal profit means the profit earned by the business if we invest the same money, not in the business, if we give to someone else. That means if we suppose keep in the bank, what the bank will give? They will give some profit? No, they will never give profit. They will give only interest. Whatever the profit we get from the business, that is we work hard and we invest, take a risk, so we get more profit. If we invest the same amount, if we give to someone else, that means they are going to give only interest. The difference of that, whatever the profit we earn from our business and whatever the interest we get from the bank, that difference is called the super profit. That is called the extra profit. Extra profit we earn from the business, that is called the super profit. Okay. Now the super profit method. See here, what is the information given here? Assets are given 12 lakhs and liabilities are given 4 lakhs. Expected rate of return, that what I said, if we invest into bank, what they will give? This only 10%. So that means we have been given this profit of 3 years. Can we use here weighted average profit method? Can we use? Why not? Because the profits are not continuously increasing. After 130 it is 110 and 120. So it is not in increasing trend, right? So we cannot use that. So now we have to calculate. You can see the table has been prepared. So total assets minus total liabilities is net asset, or it is capital employed. That means capital invested in the business is 8 lakhs rupees. Okay, clear? After that, this is 8 lakh rupees capital invested. Now expected return is 10%. That was given in the question. Now expected profit or the normal profit, right? So that formula is capital employed, that is capital invested. Capital invested, what is given? Capital invested. What is capital invested given in this question? Right? So capital invested is given 8 lakhs rupees into 10%. Into 10% is 80,000 rupees. You can see this 80,000. This is the normal profit or the expected profit, right? You can see that. What is expected profit? Whatever we get from the bank. What example I have given? Whatever we receive from the bank. That means from outside we received only 80,000. And what is the average profit? How we calculate the average profit? Average profit, how we calculate? How we calculate the average profit? This total profit divided by number of years. So what is total profit? If we add all the 3 years profit, 130, 110 to 120, that is 360. So 360 divided by number of years 3. So we get 1,20,000 as average profit. Okay. So average profit is 1,20,000 and super profit from formula is average profit minus expected profit. Now average profit we have calculated this 120, and in the previous you can see that 80,000 we have calculated this 80,000 rupees. So okay, 80,000 this and that 80,000 minus 120 minus 80,000, what it comes? What it comes? 40,000. So what do we get? 40,000 we get, right? So 40,000 is the answer. What answer we got? Super profit is 40,000. Now we have to use the formula. What formula we use? Goodwill is equal to super profit into number of years purchased. So number of years purchased, what it was given? You have seen in the question what it was given? Super profit, number of years purchased. Goodwill on the basis of Pushpa sharing profit. They decide to determine the valuation of goodwill on the basis of firm's profit, other information, goodwill. 3 years purchase. Okay. They have given 3 years purchase, right? So 3 years purchase is, okay, it is given 3 years purchase. So we can see here 3 years purchase. So we have to take 3 years purchase of super profit. Super profit into number of years purchase. So number of years purchase we have seen, right? So we can take this super profit into number of years purchase. So super profit is, you can see 40,000 into 3. So 1,20,000 is the valuation of goodwill. Goodwill is valued into 3 years purchase. So 3 years purchase is, so that is, this is goodwill amount. 1,20,000, the value of goodwill of the firm, that is 3 years purchase. If you do, it is 1,20,000. So that's the way we can calculate the goodwill, right? Is it clear? Yes. Then we can see the next method. From the following information of Manoj and Harish firm, determine the value of goodwill by capitalized average profit method. It is a different method. Unless the word capitalization comes, you don't have to think anything. When the word capitalize comes, that means you have to use this different method. Only when the word capitalization comes, then only you have to use the different method. Otherwise, the method will be same. Now we can see what is the information given in the question. This is the profit given in the question. What are the profit? 91, 110, 130, 150. So is the profit increasing? Yes or no? Yes, it is increasing. So what you have to do? You have to use weighted average profit method. So we will see other information. What the other information is given, right? So we can see additional information. Asset of the business is 13,40,000. Liabilities of the business is 3,40,000. And normal expected rate of the business is 10%. This information is given. So you can see the statement of showing computation of goodwill. So first we will see the capital employed. How the capital employed is calculated? This assets minus the liabilities. So assets minus liability, if you do 1340 minus 340, it is 10 lakhs rupees. So 10 lakhs is capital invested, or you can say capital employed. Now we have to calculate weighted average profit method. So how weighted average profit method is calculated? So that's, you have to prepare again a table of weighted average profit that we have seen, right? The year profit, weight, and the weighted profit. Weighted profit is also called the product. Now the same, you have to write the profit, this profit, then you have to multiply this into this. So what you will get? 90,000 into 1. First year you will get 90,000 into 1. So 90,000 into 1 is 90,000. Then second, 1 lakh into 2, that is 2 lakhs rupees. Same way, 110 into 3, that is 330. Then 130 into 4, 520. 1 lakh 50,000 into 5, 750. And which total we have to take now? We have seen previously. So we will take the weight total and the weighted profit total only. So it is 15 and it is 18 lakh 90,000. Okay. So we can see the next. Now we will calculate the weighted average profit, total weighted profit divided by total weight. So this is 1890 divided by 15. 15 is weight total. So what do we get? Weighted average profit. So we got only 1,26,000 as the weighted profit, right? So now we can see, now we have to calculate other things, that is capitalized profit we have to calculate. So capitalized profit method is, formula is average profit divided by expected rate of return into 100. So average profit in the previous question we have calculated 1,26,000 into 100 divided by 10. So we can see that, so the amount is 12,60,000. So this amount we got, this is capitalized profit. This capital profit is required to calculate the goodwill. The next formula is goodwill is equal to capitalized profit minus capital employed. Capital employed was 10 lakhs and we have calculated 12,60,000 minus 10 lakhs, that is 2,60,000 is the goodwill amount. This was the weighted profit we have calculated, right? Okay, clear? So this is the next formula, and one more formula is there for it. We will see that formula. Yes, we'll see the next formula. What formula is given in next formula? Yeah, we can see the example. So here is the calculate weighted profit. So weighted average profit, that is calculated 18,90,000. So 126. So how many formulas we have done today? We'll revise it. First we have done the average profit method. Average profit method was what? Total profit divided by number of years. Then second, weighted average profit. What is weighted average profit? Why we take weighted average profit? Because the profit is continues increasing. Every year the profit should increase. That's why we have taken the weighted average. Next, the next formula was super profit. What is super profit? Average profit minus expected profit. So that is super profit. Super profit, how we calculate goodwill in that? Super profit into number of years purchase. And how we calculate expected profit? What is expected profit? How we calculate? What is the formula for that? Capital employed into normal expected rate of return divided by 100. So that is the expected profit, right? So that way we can calculate. Then what was the next method? Capitalize method, right? Goodwill by capitalization method, that is average profit method. So what is average profit method, capitalization method? What we calculate? We calculate capitalized profit. How we calculate capitalized profit? Average profit divided by expected rate of return into 100. So that is called capitalized profit. Then how we calculate goodwill? Goodwill is equal to capitalized profit minus capital employed. So that way we get the goodwill. Okay. So I think that's all for enough this chapter. So almost all the formulas are covered in this. So we have covered all the formulas. Okay. So I hope you understood all the formulas and it is clear, the concept is clear regarding the valuation of goodwill, how to value the goodwill, right? So I think it is very clear to you. Okay. Thank you.